Imagine this for a second. You wake up in London in the summer of 1772. You are a merchant, and everything seems fine. Trade is booming. Ships are coming and going. Credit is flowing like water. And the city feels like the beating heart of global finance. You leave your house thinking about new deals, not about losing everything. And yet, by the end of that summer, people just like you are going to be ruined by a bank crisis you did not see coming. So what actually happened there, and why should you care today? You live in a world that talks non-stop about financial crises, from 2008 to crypto crashes. But your brain probably thinks that global contagion is a modern invention. The fun part is that it is not at all. Long before Wall Street, before the country of Uncle Sam was even independent, London and a few other cities were already tied together with invisible financial chains. When one link snapped, the whole chain started shaking. Now, picture the city itself for a moment. London in the 1770s is dirty, crowded, noisy, and rich, all at the same time. The British Empire is trading with India, the Caribbean, and the American colonies, and piles of goods are moving in and out of the city port every single day. Behind that physical movement of goods, there is something you do not see on the street, and that thing is credit. Without credit, those ships simply do not sail. Credit, in the simplest terms, is just trust turned into numbers. You promise to pay later, someone believes you, and that belief is valuable. In the 18th century, that trust usually traveled on small pieces of paper called bills of exchange. A bill of exchange is basically the grandfather of your modern bank transfer, a written order saying, "I will pay this amount to this person in this place on this date." It sounds simple, but that little piece of paper is going to be the weapon that spreads panic across Europe. Here is the key thing you need to understand, and do not worry, no heavy jargon here. Okay, money back then is not just shiny coins of gold or silver, what people call specie. There is never enough metal to match the amount of trade the empire wants to do. So merchants and bankers build a parallel money system out of promises, signatures, and reputation. If you are a respected house in London and you sign a bill, that signature can be accepted and resold like money from Amsterdam to the American colonies. Now, as soon as money stops being only metal and becomes a web of promises, something else appears on the scene. That something is leverage, which is just a fancy way of saying using borrowed money to make your bets bigger. When you leverage, you use other people's money on top of your own capital, and your gains and your losses both get multiplied. If things go right, you look like a genius. If things go wrong, and they will at some point, the fall is brutal. In this world, London banks and merchant houses are the cool kids of finance. They sit in the middle of trade routes, they know everyone, and their names are basically brands. A well-known London firm can endorse a bill of exchange, and suddenly that piece of paper becomes as trusted as hard cash. And here is where the plot thickens for you. Because once trust turns into a product you can stamp and sell, there is a huge temptation to stamp way too many promises. By the early 1770s, one of the shiniest names in London finance is a partnership called Neil, James, Fordyce, and Down. Think of them as a mix between an investment bank and a hedge fund, but with wigs and quills instead of suits and spreadsheets. They deal in bills of exchange, they invest in the booming East India Company, and they sit at the center of a big network of credit. Lots of people, from small merchants to Dutch financiers, are relying on their good name. And here comes the question that should already be buzzing in your head. How can one bank, even a famous one, threaten to break half the financial system? The answer is in the structure of those credit chains. You have bills endorsed on top of bills, promises resting on earlier promises, like floors in a tower made of paper. As long as everybody believes the tower is solid, nobody worries. The moment someone doubts one floor, they start to wonder whether the whole building is about to fall. Now, bring yourself into the picture. Imagine that you are a trader in London, and you hold several bills guaranteed by this fancy house of Fordyce and friends. For you, those bills are almost like cash. You use them to pay your suppliers, you use them as collateral for your own loans, and maybe you even sleep better because you think your money is safe in their hands. What you do not see is that behind the curtain, some very risky bets are being made with that trust. The wider context is also important, and you, as the smart viewer you are, should not ignore it. Britain is engaged in heavy overseas trade, there is speculation in company shares, and politics is tense in places like the American colonies. When the environment gets more unstable, the financial system becomes more sensitive to any shock. It is a bit like stacking more and more weight on a table that already looks a little wobbly. One more push, and things start to creak. Here is where another concept comes in, and this one is absolutely central to your modern life too. That concept is liquidity, which is just how quickly and easily you can turn an asset into money that people accept. In a boom, liquidity feels endless because everyone is happy to accept your paper and your promises. In a panic, liquidity evaporates because nobody wants paper anymore. They want coins, they want certainty, they want to sleep at night without sweating. The London of 1772 is a place where liquidity has been taken for granted for a while. Banks and merchant houses assume they can always roll over their debts, which means taking new loans to pay old ones when they come due. You maybe do something similar today when you refinance a mortgage or roll a credit card balance. As long as everyone keeps lending, the music keeps playing, and the party feels safe, even if the floor is getting dangerously crowded. So what is the exact moment when the music stops? The spark is a combination of overextended bets and a loss of confidence, centered on one of the partners of that London house, a man named Alexander Fordyce. Do not worry, we are going to spend a whole chapter on his story later. But for now, you only need to know this. He is massively leveraged, heavily exposed to a single type of asset, and funded with short-term credit that can vanish very quickly. When rumors start swirling that Fordyce cannot meet his obligations, the first reaction is not rational calculation, it is fear. You might think that bankers are cool and analytical, but under pressure they are as human as anyone else. If you hear that a big name might not pay, you try to pull your money out, you stop rolling credit, you call in loans earlier than usual. It is the same herd behavior you see in a bank run today, just with horse carriages instead of smartphones. At this point, you might be asking yourself, okay, but how does this jump from one London house to a full-blown international crisis? The answer lies in who holds those bills of exchange and how interconnected the credit web is. London banks have obligations to Amsterdam bankers, Scottish institutions, and colonial merchants. And those players in turn have their own chains of promises. When one big node in the network fails, all the connected nodes suddenly have to rethink their position. Think about it like this. If you have ever used a peer-to-peer payment app, you know that when one account gets frozen, everyone who was expecting money from that person gets annoyed. Now scale that annoyance up into existential panic for companies whose entire working capital is tied into these bills. Merchants who thought they had a pile of safe liquid assets find out that some of those assets might be worth much less than expected, or might take a very long time to turn into cash. The really uncomfortable part, and this is where you should start seeing the parallel with modern times, is that nobody knows where the losses actually sit. There is no central database, no real-time clearing system, no regulator with a full picture of exposures. So every institution begins to suspect that every other institution might be hiding a bomb in its balance sheet. When information is poor and trust collapses, the easiest reaction is to stop lending altogether. That decision to stop lending is like slamming the brakes on a highway full of speeding cars. You might think you are protecting yourself, but the sudden stop causes pileups behind you. Firms that relied on rolling their short-term credit suddenly have to pay in full right now, and they just do not have the coins. They start selling assets quickly, sometimes at fire sale prices, which pushes those prices down and hurts everyone else holding the same assets. You can see how this becomes a vicious circle. So, the big picture you need to carry from this first chapter is quite simple, even if the details look messy. In 1772, London is not just a city, it is a hub in a global web of credit, stitched together with paper promises and human reputation. A single highly connected bank, taking outsized risks with borrowed money, manages to shake that entire web when it stumbles. What makes the damage global is not technology, it is structure and human psychology. You might be wondering now, is this really that different from what happens in your time? A big institution, lots of leverage, a loss of confidence, and then contagion through a network of obligations. It all sounds weirdly familiar. Right. The tools have changed, sure. You have derivatives and high-frequency trading instead of quills and ledgers. But the underlying game of borrowing short, betting long, and praying that nobody asks for their money back too soon is older than you think. Before you jump ahead in your mind to 2008 or to the latest crypto meltdown, stay a bit longer in that summer of 1772. Imagine the quiet moment just before the panic, when people are still making deals, opening letters of credit, and planning business expansions. None of them has, in their calendar, a reminder saying, "Global crash scheduled for this afternoon." That is the point. Crises do not send you a calendar invite. In the next part of this story, you are going to dig into the plumbing of that old-school credit system, so that phrases like bills of exchange or merchant houses stop sounding like exotic museum pieces. Once you really get how those credit chains worked, you will see why the fall of one London bank could scare merchants in Amsterdam, landowners in Scotland, and traders in the colonies. And more importantly, you will start to see the hidden credit chains that surround you today, even if they hide behind cleaner interfaces and more polished marketing. You have probably used a credit card, right? You swipe, you sign, and you trust that somewhere in the digital void, money moves. Now, rewind 2.5 centuries, before any app, before Wall Street towers, before any concept of central banking. The world of finance in the 1700s runs on the exact same idea as your credit card, trust, just written in ink instead of pixels. To get this story, you first need to understand what money actually means back then. Forget banknotes for a moment. Those are still young and rare. Most transactions rely on something called specie, which means gold or silver coins. The problem is, there is never enough metal going around to match the size of global trade. So merchants invent tools to stretch their liquidity. One of those tools, the most powerful one, is the bill of exchange. Think about what that means for the economy of the time. Paper is acting as money, and money is acting as a social agreement. You are no longer trading coins. You are trading beliefs about who is trustworthy. If you endorse too many of these bills, you expose yourself to losses if any of the previous signers fail to pay. So a credit chain is literally a line of humans tied together by confidence. Here is a modern analogy that will make the mechanics clearer for you. Imagine you are in a group chat where people lend and borrow each other money using promises. As long as everyone keeps their word, everyone can keep shopping, dining out, and bragging about their credit score. But if one person disappears, every deal they touched turns suspicious. Suddenly, no one wants to pass these promises around anymore. During the 1700s, this system of bills replaces a huge part of what we now call banking reserves. Instead of one central institution managing liquidity, every merchant acts a bit like a microbank, issuing and endorsing promises that can circulate for months. That freedom fuels trade because money can hop from London to Amsterdam, to Glasgow, to the Caribbean colonies, all without any metal physically moving. Global commerce runs on handwriting and reputation, but trust, as you already know, is fragile. Each bill in the chain is only as good as the weakest signature on it. Once someone misses a payment or gets a bad reputation, the value of linked bills drops instantly. Think about it like watching a crypto token lose half its price overnight because someone questioned its backing. Confidence is invisible, but it moves markets faster than any ship or carriage. Because of this dependency on trust, merchants begin to develop informal networks for information. There are gossip channels, letters, coffee houses where people whisper about who might be struggling. These social networks, powered by rumor, work like the 18th century version of financial news feeds. A simple whisper about a shaky bank in London can make Dutch investors in Amsterdam stop accepting certain bills. In those coffee houses, you would recognize the energy instantly. Men in wigs leaning in, exchanging facts, maybe exaggerating a bit, calculating risks in their heads. There are no credit ratings or databases, only word of mouth. The more your name circulates positively, the cheaper your credit becomes. The moment someone doubts your solvency, your cost of doing business skyrockets. That system sounds chaotic, and it is. But it also works astonishingly well as long as growth continues and everyone plays fairly. During peaceful decades of the 18th century, bills of exchange create a roaring trade network. British merchants finance goods from Asia, Dutch financiers invest in transatlantic ventures, and Scottish bankers develop long-distance credit connections that will later shape modern banking itself. It feels like a perpetual motion machine powered by ink. However, you know that perpetual motion does not exist. The more interwoven these credit chains become, the more efficient they look and the more fragile they actually are. Imagine a spider web stretched wider and wider across continents. The silk strands hold until one small gust of wind snaps a thread, and the vibration travels all the way through. That was basically the structure of 18th century global finance. Let's break this down with a simple mental exercise. Suppose you are a Glasgow merchant who sells textiles to London, financed through bills endorsed by your banker. Your banker, in turn, relies on a larger London house to guarantee those bills, and that house borrows from Dutch partners who recycle bills back into Caribbean trade. You are effectively several steps removed from the actual gold supporting your transactions, yet all of you behave as if that gold is already in hand. What keeps this merry carousel moving is confidence and speed. Bills have due dates, say 3 months, but merchants often roll them over instead of paying them off. Rolling over means you draw a new bill to pay for the old one, basically refinancing your debt. As long as there is appetite for your signature, you can keep rolling indefinitely. Sound familiar? It is the ancestral cousin of today's short-term credit markets. Now, pause a second and think what could go wrong with such a system. First, small errors or rumors cascade easily. If one merchant defaults, everyone connected to their chain has to cover the missing funds, often by calling in other debts. Second, there is massive opacity. No one knows exactly how many bills are floating around or how sound the endorsers truly are. Finally, if confidence dries up, liquidity collapses overnight. No new bills get accepted, and trade grinds to a standstill. To give you a sense of how powerful this structure becomes, remember that Britain's entire imperial trade machine relies on it. Tea from China, sugar from the Caribbean, timber from the colonies, all financed through promises written in London or Amsterdam. Those pieces of paper circulate globally, and any weak link can cause ships to stay docked and warehouses to overflow. Credit is not just financial infrastructure. It is the invisible wind filling the sails of empire. There's another element at play here that you should keep in mind: exchange rates. Since each major trading city uses slightly different currencies and coins, bills of exchange often specify a payment amount in one currency to be settled in another city's currency later. That adds a layer of complexity. Traders have to anticipate changes in relative value, much like modern investors deal with forex risk. Again, 18th century problems, 21st century flavor. So how do people manage risk in a world without central banks or deposit insurance? The answer lies in personal networks and family ties. Merchant houses rely heavily on reputation sustained over generations. Marriages between families double as business deals. If your cousin runs a bank in Amsterdam and you trade from London, your partnership is anchored on honor as much as on profit. Fraud is rare in the top networks because being caught means social and economic death. Still, the temptation to overextend credit grows with each successful trade cycle. When profits are high, everyone believes they are smarter than the previous generation. They issue more bills, stretch deadlines longer, and rely on new customers to pay old debts. Sound like a Ponzi structure. Not quite, but dangerously close. The moment external conditions tighten, the weakest hands collapse first, spreading panic outward. Another fun fact here, even governments use this system to borrow abroad. Crown agents or state contractors float bills to finance wars or infrastructure, hoping future tax revenues will cover them. In such cases, private and public credit intersect, which multiplies exposure. If a private house fails, a whole chain of public payments might freeze. This mix of government and private finance makes the upcoming crisis of 1772 even nastier. As a viewer, you should see that what we call modern global capitalism did not appear suddenly with skyscrapers. Its DNA evolved in small counting rooms with ledgers, candles, and men balancing columns with quills. Risk, leverage, trust, those three ingredients already formed the secret recipe. What changes over the centuries is only the speed and the technology, not the human logic underneath. Let's frame this with another analogy for you. Consider your social media feed. Everyone seems connected. Every post linked, every comment echoing through circles. If one major influencer vanishes, the conversation twists. Algorithms panic. Visibility algorithms rewire themselves. In 18th century credit, it's the same dynamic. Few influencers control large webs of reputation. A single failure posts a shockwave that reshapes the whole network overnight. You might think of a bill of exchange as a proto-smart contract. It specifies who owes whom, under what conditions, and who the intermediaries are. But instead of running on blockchain code, it runs entirely on mutual trust recorded in ledgers. The validation mechanism is your name, and the enforcement mechanism is shame. You fail to pay, your social capital collapses, and good luck ever doing business again. So when that collapse begins in 1772, it's these bills that transmit the shock across borders. Their paper movements connect London's panic with Amsterdam's bankers and Scotland's merchants. Credit chains that once enabled efficient flow now become chains dragging everyone underwater. Every signature that previously inspired confidence turns into a liability to be feared. Looking back, it is easy to criticize the fragility of such a system. But remember the flip side. Without those credit webs, international trade could never have reached the scale it did so early. They enabled innovation, flexibility, and global economic communication centuries before telegraphs, let alone the internet. Humans have always tolerated risk in exchange for growth, and bills of exchange are just another manifestation of that eternal trade-off. Before finishing this chapter, take a moment to connect these dots with your own financial environment. Every online transaction you make, from paying bills through your phone to using buy now, pay later at checkout, relies on exactly the same principle. Some stranger trusting digital numbers to settle later. Credit, in all ages, is a mix of faith and math. Once faith cracks, math alone cannot save the system. In this way, you can think of the 18th century as the training ground for modern finance. The players learned to weaponize trust, to spread risk across distance, and to create leverage that hides until it suddenly explodes. These lessons, passed quietly across generations of bankers, still shape your world today. Understanding these old credit chains is like decoding an ancestor's diary. It tells you who you are financially and why crashes never really vanish, but simply change costumes. Every great financial crisis has its symbol, that one individual whose greed or recklessness turns into a story bigger than life. In 1772, that symbol is a man named Alexander Fordyce. He is not a villain from a movie, but a perfect product of his time. Charming, flamboyant, daring, and addicted to risk. If he lived today, you would probably see him on social media flexing his gains and preaching confidence right before everything collapses. Fordyce begins like many ambitious Scots arriving in London to chase fortune. He enters finance through merchant banking, a business that combines trade and credit, and quickly proves he has a talent for speculation. Speculation, by the way, is just a fancy term for betting on prices. When you speculate, you are not interested in owning the thing, only in guessing where its price will go and making profit from that movement. By the early 1770s, Europe is buzzing around the East India Company. This company, half corporation and half empire, controls vast trade routes with Asia. Its shares are among the hottest assets in London, and prices have been climbing for years, fueled by enormous expectations. Everyone who is anyone in finance owns a piece of it, or wishes they did. Fordyce is one of them, and he takes his enthusiasm to extreme heights. He does not simply buy a few shares. He borrows heavily to amplify his position. That borrowing, called leverage, is what multiplies both profits and disasters. To give you an idea, it is like playing poker not just with your own money, but also with your friends' savings and your neighbor's mortgage, hoping you win before the dealer notices. The house he represents, Neil, James, Fordyce, and Down, is considered respectable and influential. They use their reputation to attract deposits and trade credit bills, effectively acting as a financial hub for merchants and investors. What most clients never realize is that part of those funds are quietly channeled into Fordyce's speculative adventures. He treats other people's trust as his personal fuel for massive bets. Now you might wonder, why does nobody stop him? Simple. Because he looks like a winner. His confidence is magnetic. His profits are real, for a while. And in finance, people tend to forgive risk when it works. Fordyce hosts lavish dinners, dresses like someone who already controls the future, and claims special insight into the market. And here's the thing. When someone gets rich quickly, crowds always assume they know a secret. The system of checks and balances at that time is minimal. There are no public records, no regulators, and no risk departments checking exposure. The entire credit network runs on handwritten promises. As long as the firm pays its bills, no one asks too many questions. Confidence creates blindness, and that blindness multiplies when profits come flowing in like a golden river. Fordyce bets on one big idea, that the East India Company's share price will keep climbing. But markets, even in the 18th century, have moods. In the months leading up to the summer of 1772, those shares begin to wobble. Rumors spread about the company's huge debts and management issues. The stock stops rising and starts tumbling little by little. To someone as leveraged as Fordyce, that small change feels like an earthquake. His positions, funded by short-term loans, start bleeding money every day. He needs new credit constantly just to cover the losses, borrowing from Peter to pay Paul. It's the classic spiral you still see in modern financial blow-ups. One bad trade wrapped in layers of borrowed trust that turn a mistake into a catastrophe. Here comes the dramatic part. As the price continues to fall, creditors become nervous. They start to withdraw their loans, reducing the liquidity Fordyce desperately needs. Imagine losing chips at a casino while being told that you must pay your debts tonight in hard gold. The act of saving himself by selling shares only accelerates the fall, feeding his own destruction. By early June, the rumor hits the London coffeehouses. Alexander Fordyce is finished. He owes massive sums he cannot possibly repay. Merchants rush to demand cash from his firm, and panic starts to rise in the streets. Within days, Neil, James, Fordyce, and Down suspends payments, effectively collapsing under its own promises. Fordyce does not stick around to explain. One morning, before things get completely out of control, he slips out of England and flees to France. His disappearance confirms the worst fears of his creditors. The man who had once been seen as the golden boy of London finance is now branded a fugitive. It is the 18th century version of a CEO deactivating all social profiles and disappearing right as the company crashes. When he vanishes, the city loses its sense of safety. Word spreads fast through the networks of bills and endorsements. Every firm that has even the slightest financial tie to Fordyce's house finds itself questioned. Banks and merchants begin calling in outstanding debts, demanding specie rather than paper. The system that had run so smoothly on trust is suddenly paralyzed by doubt. You can almost hear the fear creeping into the meeting rooms. No one wants to be the next one caught short. There are hushed conversations behind closed doors, desperate letters sent by courier, and whispers that more houses could fall next week. In some parts of the city, crowds gather outside banks demanding payments in coin. It's the 18th century version of a bank run trending worldwide. Now let's pause and analyze the mechanics behind this panic. Fordyce's firm was connected through hundreds of bills of exchange, many of them endorsed and re-endorsed by others. When default became likely, suspicion spread through those layers. If one bill with Fordyce's signature could not be honored, how many more would fail? The uncertainty itself was lethal. People assumed the worst long before proof appeared. Even firms with no direct link to him suffered because markets operate on psychology as much as math. Once investors smell fear, rationality takes a vacation. The default of one name becomes guilt by association for dozens of others. This is what economists later call contagion, when panic jumps from healthy players to sick ones simply through shared nerves. Fordyce's personal story after fleeing adds a tragic but telling twist. In exile, he tries to negotiate settlements through intermediaries, but his fortune is gone and his credibility is beyond repair. London's newspapers treat him as both villain and cautionary tale. Pamphlets circulate mocking his arrogance, and dinner talk across Britain reduces him to a punchline, a man undone by his own courage to overborrow. If you're still wondering, why does one man's fall shake the financial world of the 18th century? The answer lies in how leveraged systems magnify human error. With every borrowed pound, Fordyce extended the size of his risk until the entire network under him carried fragments of it. Modern investors see similar cascades when giant hedge funds blow up today. It's the same pattern, only faster and digital now. The psychological part of this story is crucial. Fordyce is not an anomaly. He represents the eternal temptation of finance, the belief that this time is different. You could replace his East India Company shares with internet stocks, mortgage-backed securities, or crypto tokens, and the narrative would still fit perfectly. Confidence mixed with easy credit always creates the illusion of genius that later turns to disaster. Looking around in 1772, London's other bankers realize the obvious danger. They start rewriting their own ledgers, double-checking exposures, and limiting new credit. The flow of money tightens across the city. Merchants accustomed to easy financing suddenly find their requests refused. What had been a booming cycle turns defensive in the blink of an eye. You might think this correction would stay local, maybe confined to London, but remember the credit chains you learned about earlier? The bills connecting these firms reach Amsterdam, Hamburg, Edinburgh, even Philadelphia. When London's key node collapses, all peripheral nodes tremble. Distant merchants who have never met Fordyce personally watch their transactions freeze, simply because they trusted paper that traced back to him. And here lies the brutal beauty of early globalization. Its speed is limited by horses and ships, yet its psychological transmission is near instant. Letters carrying bad news travel fast because fear always finds transport. Within days, Amsterdam financiers refuse to accept certain London bills, unsure whether they are tainted. Transactions stall, new trades halt, and cash becomes king once again. Fordyce tries to negotiate his way back to life, but that door closes. The once ambitious banker turns into a cautionary tale discussed across Europe's financial press. Governments and investors alike begin realizing how fragile prosperity built on credit could be. Historians later mark this as the dawn of modern financial awareness, a collective lesson about overconfidence and interconnection. So, what is the key takeaway for you sitting centuries later in front of a screen? It's that the face of financial risk is always human. One person's ambition, ego, and misjudgment can ripple through entire worlds of commerce. Systems evolve, laws improve, computers accelerate decisions, but the human craving for high reward remains constant. No matter the century, leverage amplifies both profit and panic. By the end of this chapter, Fordyce stands as both warning and mirror. His empire of promises and his spectacular collapse mark the point where London learns that credit without discipline is a time bomb. Every modern regulator, every risk manager has Fordyce's ghost buried somewhere in their textbooks, even if they don't know his name. The next part of our story shows how his fall set Europe on edge and turned confidence into chaos across the continent, proving that even then, the markets had no borders. If you thought the collapse in London was bad, just wait until you see what happens next. Crises never stay still. They move, traveling through the same channels that once carried prosperity. In the summer of 1772, fear becomes the fastest export product of the British Empire. Let's start with Amsterdam, the beating heart of European finance. By this time, the Dutch Republic is the closest thing the 18th century has to a global central bank. Amsterdam merchants and bankers finance trade routes from India to the Caribbean, and their institutions are built on precision, discipline, and reputation. The city's Bank of Amsterdam is considered one of the most stable in the world, but even that fortress is not immune to panic. Now, imagine being a Dutch banker hearing the latest gossip from London. A massive house has failed, investors are vanishing, and nobody trusts anyone. You do not yet know whether the rumors are exaggerated, but you know one thing for sure. Many of the bills in your drawers come from London firms. Every sheet of paper suddenly looks suspicious. A few signatures that seemed golden just last week now feel radioactive. Confidence, the oxygen of finance, starts to thin out. Traders in Amsterdam begin tightening credit lines to British merchants. They demand repayment in coin instead of paper. The flow of bills slows, exchange rates begin to wobble, and markets turn defensive. And before you realize it, the city that prided itself on calm rationality starts behaving exactly like panicked London traders. To make matters worse, the speed of communication is slow, but not slow enough to prevent contagion. It takes a few days for letters to cross the North Sea, but fear does not wait for verification. Merchants assume the worst, because in finance, it is safer to be wrong and cautious than right and bankrupt. So one broken bank in London quietly freezes trade hundreds of miles away. You can think of Amsterdam as the control tower of world commerce. The city not only finances trade, but also prices risk for everyone else. When that control tower sees smoke coming from London, it signals danger across the continent. Dutch investors start recalling funds from Scotland, France, and even the colonies. Liquidity that once fueled global trade quickly drains back to safety. Now let's sail north to Scotland, where the banking culture has been booming. Scottish banks are young, innovative, and proud of their cautious reputation. They finance local industries and help colonies manage credit. But many of these institutions also hold London bills, because that's where international payments clear. So when London sneezes, Scottish banks catch pneumonia. In Edinburgh and Glasgow, rumors from the south arrive fast and terrifying. Merchants gather in clubs and cafes, exchanging panicked whispers. One small failure after another ripples through local trading houses that had backed their operations with London bills or Dutch credit. Within weeks, several Scottish banks are forced to suspend payments temporarily, something unheard of only months before. Here's the problem in simple terms. Everyone owes everyone else. Imagine a huge web where each knot supports several others. If one knot loosens, the strain redistributes unevenly, tightening some threads to their breaking point. That is exactly what happens when Fordyce's collapse ripples outward. Each city experiences its own version of the same nightmare: sudden distrust and vanishing liquidity. The Scottish example is particularly brutal because people there have been pioneers of modern banking. Their system operates with something close to a fractional reserve model, which means they keep only part of deposits in cash and lend out the rest. It works beautifully when confidence is high, since not everyone demands their money simultaneously. But once the crowd rushes in, even the best-run bank looks fragile. Picture the scene. Depositors lining up, clerks behind desks counting coins, and managers trying to calm the crowd with fancy words. This is not just a local inconvenience. When those Scottish banks close their doors, many connected firms in London and Amsterdam lose expected payments. Letters of credit expire, ships remain unloaded, and the chain effect spreads further down. At this point, government officials in both Britain and the Dutch Republic begin to worry. They realize that this is not a random accident, but a systemic fracture. But back then, there's no central bank ready to inject liquidity, no lender of last resort. The only tool they have is persuasion, pleading with creditors to stay calm and trust that order will return. Trust, though, is already broken. In economic terms, what you're seeing is called a liquidity crisis. It's when perfectly solvent entities can't meet short-term payments because cash dries up. Today, we have emergency credit lines and deposit insurance to handle this. In 1772, none of that exists. If you're out of cash, you're dead in the water, regardless of your underlying wealth. Now watch how the chain continues westward across the Atlantic. Dutch and Scottish investors have money tied up in colonial trade, from plantation goods to timber exports. When credit freezes in Europe, payments to colonists in America slow to a crawl. Ships carrying goods arrive with bills that nobody wants to honor. The crisis jumps oceans effortlessly, showing just how global finance already is. Amsterdam's merchants soon have to make difficult choices. Some decide to liquidate foreign interests to cover domestic obligations. Others, especially smaller houses, simply fold under the pressure. A few large names survive, but only by drastically reducing their exposure abroad. The great web of global credit that seemed unbreakable a month earlier now feels like thin glass ready to crack again. Let's pause here and make something clear. No one planned this contagion. It's not a conspiracy or some shadowy coordination. It's just the natural consequence of an interconnected system. When every promise depends on another, panic spreads like electricity in a storm. Fast, invisible, and destructive. At the same time, not everything collapses. The Bank of England steps in quietly to support certain key houses, lending against collateral so that the entire British system doesn't implode. It's one of the earliest moments in history where an institution behaves, unknowingly, like a modern central bank. But their tools are limited, and much of the economic damage is already done. The Amsterdam exchange, usually calm and liquid, begins to show wild price swings. Investors call in debts from abroad, pushing foreign borrowers into default. Scotland continues to freeze, with merchants unable to draw new bills or refinance existing ones. Whole regions dependent on credit-backed trade suddenly find themselves in near paralysis. The domino effect is in full motion. By autumn, continental Europe feels the tremors. In Hamburg, traders whisper about English insolvency. In Paris, government officials discuss the need to review exposure to British credit. The global economy, though smaller than today's, shares the same architecture of dependency. Everyone depends on someone else's promise. Once those promises break, fear travels faster than ships. To make this more relatable for you, think of the 1772 crisis like an 18th century version of the 2008 meltdown. Substitute London for New York, Amsterdam for Frankfurt, and Scotland for regional banks. The products may differ, bills of exchange instead of mortgage securities, but the mechanism is identical. When confidence vanishes, the network implodes from the inside. Some of the more ironic stories come from merchants who never speculated at all. They simply stored their savings or trade profits with trusted London houses. When those houses stop paying, entire families lose fortunes overnight. The echo reaches the colonies, where suddenly cash disappears, wages drop, and even small farmers cannot sell products easily. Financial panic, like a virus, doesn't care about social status. At street level, life changes quickly. Shops reduce inventory, lenders disappear, and trade routes temporarily freeze. The psychological shock is immense because everyone believed paper credit was as solid as gold. That illusion vanishes. Within weeks, centuries of optimism about the invincibility of British credit are replaced with caution bordering on paranoia. In Scotland, something remarkable happens amid the chaos. Some banks experiment with emergency measures, issuing temporary token money, extending credit to stable clients, even merging to pool reserves. These efforts are small compared to the scale of crisis, but they plant seeds for future reforms. Necessity pushes them to rethink how much trust and leverage a system can handle. Across the Channel, Amsterdam's civic leaders hold urgent meetings. They debate how to contain the disruption, fearing that if Dutch credit collapses, world trade might grind to a halt. Eventually, through a combination of local support and sheer resilience, Amsterdam stabilizes. Its conservative policies, keeping high reserves and limiting risky deals, help it weather the storm better than others. But the scars remain visible for years. The crisis permanently alters relationships between these cities. London learns that dominance comes with fragility. Amsterdam realizes that interdependence means vulnerability to distant mistakes. Scotland begins building stronger internal oversight to avoid repeating the experience. And all of them together start imagining, for the first time, the idea of coordinated financial management. If there's one lesson you should take from this global domino effect, it's that distance offers no protection when credit is the glue. The crisis of 1772 proves that interconnection turns local greed into universal pain. Even without telegraphs or digital screens, markets functioned as one nervous organism. A tremor in London became an earthquake across continents. The beauty and sadness of that moment is how preventable it seemed in hindsight. Had London houses kept stricter reserves, had Amsterdam maintained insistence on transparency, had Scottish banks been more conservative, maybe the panic would have stayed local. But finance thrives on optimism until reality intervenes. Every crash begins as a story of too much trust. By the time winter arrives, trade begins to recover slightly, but in a new mood, colder, more cautious, and sober. The survivors rebuild balance sheets and replace old paper with new promises. Life resumes, but the air feels heavier. The glittering dream of endless credit progress has dimmed, replaced by a quiet question that you might recognize today. How stable is the world when everything depends on trust? Now that panic has shaken London, Amsterdam, and Scotland, it is time to look at what happens on the other side of the ocean. You might think that the Atlantic distance would shield the American colonies from this financial earthquake, but it actually does the opposite. The colonies are tied into the same invisible web of credit that connects Europe. When London sneezes, Boston and Philadelphia catch a fever. Back in 1772, colonial America's economy depends heavily on trade with Britain. Ships filled with timber, rum, and tobacco sail to London each season, bringing back manufactured goods. Local merchants rarely pay up front. They rely on credit extended by British trading houses. So, when those London houses start freezing credit, life on the docks and in the counting houses changes overnight. Imagine being a Boston merchant opening your mail one summer morning. You expect letters of credit from your London contacts, maybe a few new contracts, but instead you find delays, excuses, and polite refusals. Those words, temporarily suspended credit, slice straight through your plans. Without access to British financing, your entire business grinds to a frightening halt. At this stage, most colonial merchants do not carry large reserves of cash. Coins are scarce, paper currency is unreliable, and most trade runs on bartering or promissory notes. When London's liquidity dries up, merchants cannot pay their suppliers nor their debtors. Bills bounce, shipments stall, and warehouses fill with goods that nobody can afford to move. That sense of paralysis begins to spread across every port city. Philadelphia, the busiest colonial port, becomes a case study in panic. Merchants accustomed to easily rolling debt suddenly face demands for immediate payment. Local banks, limited in number and deeply tied to English houses, cannot provide relief. Creditors in England, desperate for repayment, send notices that sound almost cruel. Your notes are due now. The entire trading network feels its veins clog with uncertainty. If you walk into the taverns and meeting houses of the colonies, you can hear the anxiety. Importers complain that shipments are stalled. Shopkeepers worry about losing customers, and brokers argue that the crisis must be only temporary. But the truth is simple. The colonies are financially dependent on the metropole. Their economic lifeblood flows through credit extended by British bankers who now fear everyone's signature. To really understand how this affects daily life, picture a farmer in Virginia. He grows tobacco not for local use, but for export to Britain. When his London agent writes that payments will be delayed indefinitely, the farmer suddenly cannot pay workers, buy tools, or repair ships. It's a domino effect in miniature. One small example repeated thousands of times across the colonies. What makes this even more painful is that the colonies already suffer from a chronic shortage of specie, actual gold and silver coins. In normal times, that shortage is manageable because credit smooths over the gaps. But once credit dries up, the colonies face a true liquidity collapse. Paper notes issued by colonial assemblies begin to trade at steep discounts and barter returns as a means of survival. It feels like stepping backwards in economic time. Small traders and shopkeepers get hit even harder than plantation owners. They rely on short-term credit from bigger merchants, who in turn rely on London houses. When the top link in that chain breaks, everyone below it collapses in sequence. Suddenly, that friendly neighborhood lender cannot extend your usual line of goods on trust. Everyone demands cash, and since cash barely exists, commerce withers like crops in drought. For colonial governments, the timing could not be worse. Political tension with Britain is growing because of taxes, tariffs, and a sense of exploitation. Now, with the financial crisis, many colonists feel economic betrayal layered on top of political anger. The collapse of British credit makes London seem even more distant, arrogant, and unreliable. The seeds of distrust already planted by earlier taxes grow deeper roots through economic suffering. You can see how this becomes more than a financial story. It becomes psychological. Colonists who once saw Britain as the stable anchor of global trade begin to question its competence. Local newspapers fill with complaints and gloomy predictions. Some writers argue that the empire's finances are rotten to the core. Others call for self-reliance. Slowly but surely, a sense of American financial identity starts to take shape. In the ports, the effect is visible with every unloading ship. Goods accumulate because buyers cannot pay. Auctions fail, and prices for imported luxuries crash. That collapse hits artisans who depend on imports. Tailors, cabinet makers, and other trades see orders disappear. For ordinary workers, it means loss of income and a sharp decline in purchasing power. The social mood turns from optimism to quiet despair. Interestingly, not all regions suffer equally. The New England economy, less reliant on luxury goods and more diversified in small industries, adjusts better. The southern colonies, deeply tied to export agriculture, experience the worst disruptions. Their economic structure is built almost entirely on credit extended through British trade channels. When that lifeline breaks, plantation wealth evaporates almost overnight. This is where the historical irony kicks in. The same commercial networks that once bound Britain and its colonies tightly together now expose their greatest vulnerability. Dependence in finance always cuts both ways. You gain efficiency and prosperity when things go well, and you face catastrophic weakness when the center falters. The American economy learns this lesson the hard way. Let's take a closer look at the merchants' responses. Some try to form local credit associations, small coalitions of traders who agree to accept each other's bills at face value. It's a desperate move, but it keeps some trade flowing. Others turn to barter systems, exchanging goods directly without any money involved. A few innovative minds even propose the idea of issuing regional currency backed by commodities like grain or tobacco. Still, confidence remains fragile. Without the endorsement of established British banks, local credit instruments lack legitimacy abroad. A Philadelphia trader's note might circulate within the colony, but no one in London or Amsterdam will touch it. That limits their reach, creating small, isolated financial islands instead of a connected network. Local resilience comes at the cost of global relevance. The psychological pressure on colonial elites grows intense. Many wealthy families had borrowed against future shipments, expecting British credit to remain steady forever. When that expectation collapses, they must sell land or property to cover debts. Social tension follows, as long-respected merchants face ruin and humbler citizens question their authority. The collapse of trust reshapes colonial class boundaries in subtle but lasting ways. There's also an interesting flip side to this hardship. Necessity pushes colonists toward developing local industries and financial tools. With imports restricted, domestic manufacturing becomes more valuable. Local craftsmen find new customers, and early banking experiments gain traction. In the long run, this forced adaptation plants the seeds of economic independence, even if no one sees it that way yet. From a modern perspective, this colonial episode reveals how tightly connected the 18th century world already is. The fall of a single bank in London sets off a chain reaction that reaches carpenters in Massachusetts and sailors in Virginia. Globalization, though few call it that back then, is already fully operational. The colonies learn, through hardship, what it means to depend on an international credit system they do not control. Now, picture the emotional landscape by 1773. Trade volume keeps shrinking. Letters arrive slower, full of excuses and pleas for patience. Each week that passes without new credit cuts deeper into local business confidence. Meanwhile, the political debate about self-governance begins to blend with financial frustration. Economic dependence transforms into moral outrage. Some historians later link this moment indirectly to the drive toward revolution. While the crisis itself does not cause rebellion, it reveals the structural inequalities that make independence feel necessary. The idea that an entire continent's economy could suffer just because a few London speculators failed starts to look intolerable. Freedom, in this context, becomes not only political, but financial. The deterioration lasts for about a year, And then slowly trade begins to recover as new bills are issued and panics fade. But the psychological scar remains. The colonies realize how fragile prosperity truly is when controlled by distant creditors. They begin valuing local trust networks and mutual aid over foreign guarantees. It's a subtle but profound shift in economic mindset. Even after credit lines reopen, many colonists refuse to return to their former dependency. They diversify suppliers, retain more earnings locally, and start experimenting with new forms of trade finance. These steps may look modest, but they lay the groundwork for later institutions that will flourish after independence. In a way, the 1772 crash accelerates America's financial adolescence. By the end of the decade, memories of the panic fade behind larger political events, but its fingerprints remain. The colonies' growing skepticism toward British finance becomes part of their case for greater autonomy. When you hear speeches about freedom and self-determination, a few years later, remember that economic trust is part of what they crave. Control over their own money becomes a metaphor for control over their future. So, by the time you reach the closing years before the American Revolution, the financial shockwaves of 1772 have already done their quiet work. They have weakened belief in imperial competence, seeded ideas of local strength, and proven how geography cannot protect you from financial contagion. The lessons of that crisis echo across centuries. Dependence breeds vulnerability, and credit can unite or destroy with equal ease. Let's start with a question. What does a collapse from nearly 3 centuries ago have to do with your bank account, your investments, or that feeling you get when markets start to wobble? The answer is everything. Because the story of the credit crisis of 1772 is not a closed book from dusty archives. It's the blueprint for how global finance still behaves today. Think about what you just walked through. A single mismanaged bank in London set off a panic across Europe, crushed credit in Scotland, and sent shockwaves to the American colonies. Now replace London with New York, Amsterdam with Frankfurt, and the colonies with emerging markets. Suddenly, the picture looks very familiar. It's the same mechanism repeating: excessive leverage, misplaced trust, and a network too interconnected to fail quietly. What makes that old story feel so modern is the psychology behind it. Human beings haven't evolved much when it comes to money. We still swing between euphoria and fear, confidence and chaos. In good times, we overestimate our safety and invent reasons why this time is different. Then, when the bubble bursts, we scramble to blame someone instead of rethinking the structure. The crisis of 1772 teaches a simple rule: complexity without transparency breeds fragility. Back then, nobody could truly track who owed what to whom. Today, we have algorithms and digital records, but let's be honest, most people still don't understand where their money sleeps at night. Global finance is just as maze-like, only faster and dressed in better suits. So, imagine yourself as one of those London merchants. You wake up one morning confident that your signature can buy anything, and by sunset, your reputation is worthless. That sensation isn't trapped in history. It flashes again in 2008, during the mortgage meltdown, or in the sudden crypto collapses of recent years. The pattern remains constant: risk disguised as innovation, trust built on hope, and contagion spread through invisible ties. Let's break this down into 3 big takeaways. First, credit, whether it's paper bills, digital currencies, or decentralized tokens, is still faith wearing a financial costume. Without belief, it has no value. Second, leverage, using borrowed funds to magnify profit, is timeless and seductive. It makes you feel unstoppable while quietly setting a timer for disaster. Third, contagion is faster than ever. In the 18th century, it crossed oceans by ship. Now it crosses screens in seconds. You might wonder, if the dangers are so obvious, why does each generation still repeat them? Because profit has a short memory, and risk has a long one. When times are good, warnings sound boring. People who raise red flags get mocked as pessimists. You saw it with Fordyce's contemporaries. And you see it today whenever someone says a market might be overheated. But there's a silver lining to crises. They force innovation and reform. After 1772, banking systems slowly begin to adopt safeguards, better accounting, clearer records, and eventually, institutions like central banks. Out of pain comes better architecture. The same happens after each modern crash. Regulations tighten, technology improves, and society learns, at least for a while, that caution matters. If you fast forward to the modern era, the parallels become uncanny. 2008 happens because housing credit chains grow too complex to map. Everyone trusts the paper until one major player fails, and panic ripples out. Sound familiar? It's Fordyce's ghost wearing a pinstripe suit. The tools have changed, but the mechanics are identical. Misaligned incentives meet blind optimism, and suddenly the system seizes. You, as a participant in today's financial world, live inside networks just as fragile. Your online broker, digital wallet, or pension fund is tied to dozens of unseen entities. You don't need to be paranoid, but you should be informed. Knowing the history of this first global crisis gives you more than curiosity. It arms you with perspective. When markets boom, you can ask the right question. Is this growth built on solid foundation or recycled hope? Let's circle back to the emotional part. Fear spreads much faster than reason because humans are wired to avoid loss. In 1772, gossip in coffeehouses created panic. In your time, a viral tweet can do the same. The medium changes, but the emotion is identical. Understanding that dynamic helps you stay calmer when volatility hits. Fear is contagious, but so is rationality if you practice it. Sometimes it's helpful to view financial history like physics. Energy isn't destroyed. It just moves around. The same applies to credit. Trust transfers from one sector to another, one asset to another. But it never becomes infinite. It always has boundaries. When you push those boundaries with leverage, the snapback is inevitable. The only mystery is when. This old crisis also reveals how global finance ties directly into politics and identity. For the American colonies, credit failure becomes one more argument for independence. Sound familiar again? Economic insecurity has shaped revolutions from France to Latin America to modern debt protests. The connection between financial stability and social peace is unbreakable. So what would the merchants of 1772 recognize in your world today? Probably everything. Derivatives would look like stacks of complex bills of exchange. Crypto exchanges would smell vaguely of London's speculative coffeehouses. Social media influencers hyping trades would remind them of Fordyce's swaggering confidence. Even central bankers would feel like the cautious Amsterdam elders trying to calm the market by saying, "Trust the system." Your advantage, of course, is information. You can track macro indicators, read instant news, and diversify investments globally. But the disadvantage is speed. Mistakes amplify before you even notice. The lesson from this 18th century crash isn't to fear progress. It's to respect feedback loops. Every risk circulates faster now, but awareness can spread faster too if you're paying attention. Let's pause and ask something simple. How does knowing about an old banker's failure help you make better financial choices? Because understanding the structure of a problem is 50% of solving it. When you see hype or too much easy credit in your own time, you can recall this history as a mental caution sign. It reminds you that every golden promise is only as safe as the trust holding it together. In personal finance, that means questioning leverage, the temptation to borrow for the quick win. It means aligning your risk with things you actually understand rather than chasing mysterious yields. And yes, it means remembering that even experts don't escape human bias. Fordyce was considered brilliant right until the moment his empire imploded. Another lingering lesson relates to regulation. Back then, there were no safety nets, no last resort lenders. When banks failed, people starved. The slow birth of central banks and government oversight begins with crises exactly like this one. It's easy to hate regulation when the market hums, but history shows what happens when nobody's watching. Freedoms without balance lead to repetition of the same collapse dressed in modern vocabulary. Now you might be thinking, does this mean we are doomed to cycle endlessly between boom and bust? To a degree, yes, but that doesn't mean we're powerless. Systems evolve, resilience increases. Investors today have more access to knowledge and tools than ever before. The key is using them with humility, understanding that the market's memory is short, but yours doesn't have to be. The credit crisis of 1772 also illustrates that globalization isn't new. It's just faster. Trade, communication, and finance have always found ways to connect distant societies. What's different now is how immediate the consequences are. One rumor, one decision, one algorithmic glitch can echo worldwide in milliseconds. The challenge for your generation is to learn interconnection without falling into dependency. By now, you can probably see why this chapter matters. It isn't simply about bankers in wigs. It's about how fragile our shared imagination of value still is. Every financial system functions because people collectively agree to trust a piece of paper, a number on a screen, or an institution's promise. Break that trust, and the entire web trembles. Preserve it wisely, and prosperity follows. So, as you close this story, keep one metaphor in mind. The economy is like the ocean, calm one day, stormy the next, but forever connected. You can't stop the tides, but you can build a sturdier ship. Understanding storms of the past helps you navigate the ones ahead without panic. That's what historical awareness gives you. Not immunity, but preparation. Maybe next time you hear about a once-in-a-lifetime financial crash, you'll smile a little. Because you'll know that it's never truly the first time. Somewhere in London, Amsterdam, or across the Atlantic, someone once made the same mistake. And somewhere else, another person learned from it. Be the second one, not the first. History already paid the tuition for you.